As you stand at the crossroads of financial decision-making, a fork in the road beckons. A $500 increase in your mortgage payments may seem like a negligible adjustment, but its far-reaching consequences on your wealth over time are nothing short of staggering. According to data from the Federal Reserve, every dollar saved or invested now is equivalent to about $1.25 in future value, assuming an average annual return of 7%. However, this equation changes dramatically when considering mortgage payments. With rising housing costs and stagnant wages, more homeowners than ever are facing financial strain. A recent study by Zillow found that over 500,000 Americans are spending over 40% of their income on housing alone, the threshold for being considered housing burdened. When you increase your mortgage payment by $500, it may not seem like a significant amount. But let's do some math to put this into perspective. Over the course of a 30-year mortgage at an average interest rate of 4%, an additional $500 per month translates to over $240,000 in increased payments alone, before accounting for lost investment opportunities or potential interest on other investments. That's like giving up almost 3 years' worth of groceries. The impact doesn't stop there. When you divert this extra money towards your mortgage instead of saving or investing it elsewhere, you miss out on the opportunity to grow your wealth exponentially. As a result, your net worth shrinks by nearly $150,000 over the life of the loan, assuming an average annual return of 7% on those missed investments. The effects may seem subtle at first glance, but this incremental increase in mortgage payments snowballs into significant financial repercussions that can have lasting consequences for generations to come. Imagine you're standing at the crossroads of financial decision-making, with a fork in the road that could change your life forever. A $500 increase in your mortgage payments might seem like a small adjustment, but its impact on your wealth over time is staggering. Let's take John and Emily as an example. They bought their dream home for $300,000, with a 30-year fixed-rate mortgage at 4% interest. Their monthly payment was around $1,400. However, after refinancing to take advantage of the low interest rates, they decided to add an extra $500 to their monthly payments. This brought their new total to $1,900 per month. Now, let's see how this small increase in mortgage payments affects John and Emily's wealth over time. According to data from the Federal Reserve, every additional dollar paid on a mortgage reduces the principal balance by approximately 0.11%. So, that extra $500 per month is reducing their principal balance by around $550 per year. Assuming they keep making these increased payments for the next 25 years, they'll end up paying an estimated $140,000 more in interest compared to if they had stuck with the original payment plan. But here's the key point, that extra $500 per month has allowed them to pay off their mortgage 3 to 4 years earlier than originally planned. To put this into perspective, let's consider the interest rate savings alone. According to Fannie Mae, reducing the loan term by just 1 year can save homeowners around $10,000 in interest payments over the life of the loan. So, by paying an extra $500 per month, John and Emily have effectively saved themselves around $20,000 to $25,000 in interest payments. As you can see, that small increase in mortgage payments has had a significant impact on their wealth over time. But the real question is, what if they had taken this one-time payment and invested it elsewhere? Could they have earned even more in returns than the interest savings from paying off their mortgage early? We'll explore these possibilities further as we delve into the world of mortgage payments and their effects on long-term wealth creation. As we explore the effects of a $500 increase in your mortgage payments on your wealth over time, it's essential to examine the underlying factors at play. According to research by the Federal Reserve, for every dollar you pay towards your mortgage principal, it reduces the amount owed by approximately 1/7. Conversely, applying an extra $500 per month can lead to significant long-term savings. Assuming a $300,000 mortgage with a 30-year fixed rate at 4% interest, adding $500 to your monthly payments would shave nearly 12 years off the loan term. By reducing the principal balance more aggressively, you'll also minimize the total amount paid in interest over the life of the loan. To illustrate this concept, let's consider an example. Suppose you take out a $300,000 mortgage with a 30-year fixed rate at 4% interest, and your monthly payment is approximately $1,432 without the extra $500. By adding that additional amount, your new monthly payment would be around $1,932. Over the course of 3 decades, the borrower paying $1,932 per month would save roughly $144,000 in interest compared to their original mortgage payments. This translates to a significant reduction in principal and interest, P&I, costs over time. In contrast, not making those extra payments could result in thousands more dollars in long-term debt. The numbers are striking. For every $500 increase in your monthly mortgage payment, you can expect to save tens of thousands of dollars in interest over the life of the loan. As we continue our exploration of this crucial decision, it's essential to consider the far-reaching consequences on your financial well-being. Consider the average American homeowner, who dedicates nearly 1/3 of their monthly budget to housing expenses, including mortgage payments, property taxes, and insurance. A $500 increase represents about a 10% boost in these costs, which can put a significant strain on household finances. Assuming a fixed-rate mortgage with a remaining balance of $200,000 at a 4% interest rate over 30 years, every $500 increase would translate to an additional $13,434 paid towards principal and interest over the life of the loan. That's a substantial amount of money that could be allocated elsewhere, perhaps towards retirement savings, education expenses, or home renovations. However, it's essential to consider other factors beyond the raw numbers. For instance, the opportunity cost of tying up more cash in mortgage payments might mean sacrificing other financial goals, such as paying off high-interest debt, building an emergency fund, or investing in a diversified portfolio. The impact on your credit score and overall financial stability cannot be overstated either. As you allocate more resources towards housing costs, your ability to absorb unexpected expenses or maintain a cushion against economic downturns may be compromised. This can lead to a vicious cycle of increased debt and diminished financial security. To illustrate the cumulative effect, let's assume our homeowner maintains the higher mortgage payment for an extended period, say 10 years. The total savings on principal would amount to around $133,440, which could have been invested elsewhere with potentially greater returns. This raises important questions about the long-term implications of your financial decisions and whether they align with your core values and goals. As we delve deeper into the world of mortgage payments and their effects on wealth, a turning point emerges that challenges our initial assumptions. It's not just about the immediate financial burden, it's about the compounding interest over time. Let's take a closer look at a hypothetical scenario where an individual sees their monthly mortgage payment increase by $500. According to a study published in the Journal of Housing Economics, this seemingly modest adjustment can have far-reaching consequences for homeowners. For instance, if our hypothetical homeowner takes out a 30-year mortgage worth $200,000 with a 4% interest rate, that $500 increase would translate to an additional $120,000 paid over the life of the loan. The total cost of ownership would jump from approximately $240,000 to around $360,000. This increased payment burden can have a ripple effect on other areas of one's financial life. As our homeowners' monthly cash flow tightens, they may need to adjust their budget, potentially sacrificing discretionary spending or investing in long-term goals like retirement savings or education funds for children. The psychological impact should not be underestimated either. The increased stress and anxiety can lead to decreased job satisfaction, reduced productivity, and an overall decrease in quality of life. Furthermore, a $500 increase in mortgage payments can also influence one's ability to take on other financial obligations, such as home renovations or debt consolidation. This might force our homeowner to reconsider their future plans, perhaps delaying homeownership or scaling back